Frontier markets. A frontier market is a type of developing country which is more developed than the least developing countries, but too small, risky, or illiquid to be generally considered an emerging market. The term is an economic term which was coined by International Finance Corporation's Farida Khambata in 1992. The term is commonly used to describe the equity markets of the smaller and less accessible, but still investable, countries of the developing world. The frontier, or pre-emerging equity markets are typically pursued by investors seeking high, long-run return potential as well as low correlations with other markets. Some frontier market countries were emerging markets in the past, but have regressed to frontier status. Terminology. The term began use when the IFC Emerging Markets Database, EMDB, led by Farida Khambata, began publishing data on smaller markets in 1992. Khambata coined the term frontier markets for this set of indices. Standard & Poor's bought EMDB from IFC in 1999, and in October 2007, S&P launched the first investable index, the Select Frontier Index, 30 of the largest companies from 11 countries, and the Extended Frontier Index, 150 companies from 27 countries. Subsequently, MSCI Barra began a rival frontier market index, and in early 2008, Deutsche Bank launched the first frontier market exchange-traded fund, on the London Stock Exchange. Frontier markets are a subset of emerging markets, which have market capitalizations that are small and/or low annual turnover and/or market restrictions unsuitable for inclusion in the larger M indexes, but nonetheless demonstrate a relative openness to and accessibility for foreign investors and are not under extreme economic and political instability. Members could be considered to fall roughly into three groups. The term pre-emerging markets is sometimes used as a synonym for frontier markets, emphasizing the expectation that they will eventually graduate to emerging market status. Investor Marko Dmitrievich defines frontier markets as primarily the 9 smaller members of the MSCI Emerging Markets Index: Colombia, Czech Republic, Egypt, Greece, Hungary, Peru, Philippines, Qatar, UAE. He suggests that many frontier markets are quite rich, but their reduced size, trading restrictions, or foreign ownership negate their inclusion in the MSCI indices. Alternatively, Gavin Sirkin asserts that the term indicates a country that has a per capita GDP that is lower than an emerging market, yielding less spending power. Characterized by little, if any, formal consumer industries as sector, as most of the majority of transactions take place at street vendors. Alternatively, frontier markets can be closed to foreign direct investments and/or be too small for large investors to make substantial investments. The Financial Times lexicon offers an alternative definition, one that is adopted by economist David Matuen, as a market that has lower market capitalism and less liquidity than an emerging market. Their appeal to investors lays in their independence and potential for high returns. Investment case. Frontier markets have lower market capitalization and liquidity than the more developed, traditional emerging markets. The frontier equity markets are typically pursued by investors seeking high, long-term returns and low correlations with other markets. The implication of a country being labeled as frontier is that, over time, the market will become more liquid and exhibit similar risk and return characteristics as the larger, more liquid developed emerging markets. According to frontier market investors, frontier assets would actually diversify and reduce risk, which contradicts the general notion that risk would be added by including those markets. Those who have a focus on frontier markets have different views on what the future holds for the intercorrelation of countries within the asset class. While they share some economics characteristics such as young, increasing educated populations, the individual economies face different internal and external forces. Funds invest to find returns in countries that have increasing trends in domestic consumption but see the overall growth drivers for each country as being different. This investment thesis holds water as it is unlikely that a manufacturing-based economy, such as Bangladesh, would respond in the same way to external shocks as an island nation where a large proportion of the economy is linked to tourism, such as Sri Lanka. There are also other non-managed ways to gain exposure to these markets that are more generic, such as investing in frontier market indices such as MSCI Frontier Index that only invest in large liquid stocks. Frontier Markets List. A number of organizations place countries into their frontier market indices. On July 1st of each year, the World Bank divides countries into 4 categories based on GNI per capita and purchasing power parity. Past changes. Colombia was promoted to emerging market by Standard & Poor's effective September 19, 2011. There have been a number of other changes and updates over the years.